ADM stock or Archer Daniels can double from the current level in the next 5 to 10 years. At the current market cap or stock price of $45, the stock price can give you a return around 10% a year. And let me explain why. As you can see, during the last 5 years, the stock price went up over 140% and then down over 50%. You might wonder why. Because of inflation. When the price of soybeans, the price of corn during 2020 and 2022 went up, this company was able to raise prices and increase its revenue. As you can see, also the revenue during that time went up. As you can see here, from 2020, 64 billion revenue to 2022, 101 billion. So an amazing performance. And also net income has increased to 4.3 billion from 1.7 billion. So this company is able to raise prices when inflation goes up for their products. Soybeans, for instance, corn, and others. Wheat, for instance, another product they sell. So this is good that they can raise prices. And if you have another spike in the price of corn or soybeans or wheat, also this company can increase the revenue and earnings. And that's great. Now, let me show you why you will get 10% annual return from this company at the current level, at this level. You have first a dividend yield of about 4.4%, which is growing year by year. For instance, 2%, 3%, it depends on the profits, and a return from their buybacks. If you look at their capital allocation strategy over the last 5 years, you can see that 2020-21 you got a dividend, then that dividend has increased to 900 million and 1 billion so far. And then from 2022 to 2024 they start to do buybacks. So you have 4.4% return from their dividend yield, which is stable. This company has continued to pay the dividend, so you can rely on this dividend. Even if the stock price from this level goes down 50%, you will get this good dividend, close to or higher than the interest rates, and it's quite nice. And then you get a yield from their earnings. What they decide to do with their earnings, to invest in other companies, new investments, to expand their business, or do some buybacks, as they did in the past, as you can see here. So in total, if you add the total return, you can get a return about 10% from this business. And if you look at the stock price over a longer period, you can see that keeps going up. As long as the prices goes up, you have inflation, and for sure in the next 5 to 10 years, 20 years, you'll have more inflation. Also, this company will increase in the future. So this is good. As I said, at this level, you can have a 10% annual return. Another good point about this company is the management, the CEO, Juan Luciano, owns shares in this company, 74x of its base salary. So he has an important stake in this company. So he has incentives to work for shareholders, because if the company is doing great, also his investment will do great in the long term. And then, second, another good thing is that they can raise prices with inflation. And this is quite important, because if you have a spike in the price of their raw materials, and if they can't raise prices, then they'll report a decline in their earnings. But so far, as you've seen here, they're able to deliver some profits. They don't have high margins, but they're able to increase their profits when inflation gets too high. The price of their products gets too high. So this is an important fact, because other companies can do this, and they report a loss. Now, this is the upside. 10% a year and a safe investment. It's a safe investment. In the next 10 years, you have high chances to double your money. This is the upside. The downside, well, In the short term, as you've seen, the revenue has started to decline from 101 billion to 85 billion. And they expect further declines, especially in their operating profits. They provide some guidance for 2025, expect operating profit to be below to in line with prior year, expect operating profit to be lower versus prior year for the other segments. And for the segments, for instance, nutrition, they expect a higher profit. But overall, the revenue will decrease, not that much, but will decrease. Their capital expenditures will increase, as you can see here, from 1.6 billion to 1.7 billion. And as you can see, they plan to continue to do more buybacks. The number of shares to decrease from 493 million to 483 million. So you have to be aware that in the short term, the stock price may go down even lower from this level. But in the long term, it will go up. Now, if you can buy this company below 20 billion market cap, let's say 10 billion, then your return will be much, much higher. And that's a great buy. If you can buy this company when the market cap, I don't know if it will reach 10 billion, because there are low chances, but you never know. But if you can reach a market cap between 10 and 15 billion, then it's a good buy. Especially at 10 billion, it's a great buy. The problem that I have, as I said, there is also a risk with this company, is, as you can see, they did buybacks, but when the price was at the highest peak, let me show you again, 2022, 2023. Let's check the price during that time. 2022, price around $80. 2023, price around the average price, let's say $70, $80. So when the price was higher, they did those buybacks. Not during 2020. They started to do some buybacks in 2020, they're just a small amount. And in 2024, they reduced their buybacks. Of course, also their profits have decreased, and that's why you see a decrease in their buybacks. But as long as they continue to do buybacks at low prices, you are safe. You are safe. And another bad thing that can happen, but won't affect you in the long term, only in the short term, is higher expenditures than expected. This can affect the earnings, the yield from their buybacks, and might put pressure on your return in the short term, because they have to invest to support biofuel demand, to modernize their plants, and also to upgrade their processes. So this business requires a lot of capital. But overall, it's a safe investment. I mean, the stock price in the short term, over the next 1 year or 2 years, can go down from this level to $40, can reach $40. But in the long term, it will go up. And for sure, this dividend is reliable. They have the money. So you can get a dividend of around 4.4%. It may be much higher if the stock price goes down. Plus this dividend, if you check the history, ADM dividend history, you'll see that they've continued to increase their dividend. You can see here. Now they are paying 51 cents. And as you can see, it has increased from, let's go back, depends what year you want. Let's say 10 cents, 2006, sorry. From 10 cents to 51 cents. And this dividend will continue to increase because the price of those products, soybeans, corn, wheat, will go higher. They're able to increase the prices and deliver a higher profit in the future. So overall, this company will do well in the future. You won't get a high return, let's say 20% a year, but a return around 10%, you have high chances to get from this business. And if you can buy at a lower price, as I said, market cap below 20 billion, around 15 billion or 10 billion, then your return will be much, much higher and will do quite well in the long term. So it's up to you. If you like this company, you You can do your own research, and it's recommended to do your own analysis. And if you have other questions, please let me know in the comments.